Gold. Chemical structure of gold. Weight. Color. Historical use. Use in the jewelry industry. Origin and production of gold. Gold is a precious metal that has been prized for its beauty and rarity for thousands of years. It is a chemical element with the symbol O, from the Latin word for gold, and atomic number 79. Gold is a soft metal with a bright yellow color and high density. The chemical structure of gold is relatively simple, with one proton and one electron in its outer shell. This gives it high stability and makes it resistant to chemical reactions. The melting point of gold is 1064 degrees Celsius, and the boiling point is 2970 degrees Celsius. Gold is also non-toxic and easy to shape and form. Throughout history, gold has been used by people for various purposes. In ancient times, it was used to make jewelry, coins and other decorative items. It was also used in various religious and ritual contexts. Gold is still the most important material used in the manufacture of jewelry, as well as in the electronics and aerospace industries, due to its high conductivity and resistance to corrosion. In addition to decorative and technological uses, gold has been used for centuries as a store of value and medium of exchange. Gold has been used as currency throughout history, and many countries still use gold in their monetary systems today. Gold mining is a complex process that takes place all over the world. There are several methods of extracting gold from the ground, including open pit, underground, and underground mining. Most of the world's gold is produced in large-scale mining operations, although many countries continue to mine gold on a small scale. Gold mining is an important economic activity, with many countries relying on the gold mining industry for jobs and income. However, gold mining can also have negative environmental impacts, such as deforestation and the release of toxic chemicals into the environment. The price of gold has traditionally been volatile, reflecting its value. The price of gold is affected by various factors, including interest rates, inflation, political instability, and supply and demand. Gold prices have risen sharply recently, possibly due to the uncertainty created by the COVID-19 pandemic and the global economic crisis. In the US, gold has long been viewed as a safe haven asset because it is perceived to be less risky than stocks or bonds. Many Americans invest in gold as insurance against inflation and political instability. Reflecting strong demand for the metal, the US is the world's third largest consumer of gold after China and India, according to the World Gold Council. Gold is a precious and versatile metal that has played an important role in human history. Its unique features and historical significance have made it a desirable commodity not only for its beauty and rarity, but also for its use in various industries and as a store of value. Despite its importance and value, gold production has environmental and economic consequences, and its price remains highly volatile. Gold rush. The term gold rush refers to the intense desire and enthusiasm for gold that has existed throughout history. This desire for gold is driven by its perceived value as a safe haven, store of value and medium of exchange. This fascination with gold is not limited to any particular culture or time, but is a human trait that has. In recent years, the gold rush has led to strong demand for gold coins and bars, as well as an increase in the number of people investing in gold-related financial products such as exchange-traded funds, ETFs, and futures contracts. This can be attributed to increased economic uncertainty and economic volatility, which has increased the demand for safe haven assets such as gold. There are also many reasons for this hype about gold. One of these is gold's historical tendency as a safe haven, which is considered less risky than stocks or bonds and can act as a hedge against inflation and political instability. Another reason is the limited supply of gold. Gold mines of the world can produce about 2,500 to 3,000 tons of gold per year. This is less than 1% of all gold mined and a small fraction of surface gold reserves of about 190,000 tons. This limited availability of new gold reduces the available gold and increases the demand for it. In the United States, the gold rush has been especially intense in recent years, fueled by economic uncertainty and financial market volatility. According to the World Gold Council, the US is the third largest consumer of gold after China and India. The US gold market is considered one of the most mature and developed in the world, with a wide range of gold-related financial products such as ETFs and futures contracts. However, it's worth noting that this hype can have its downsides, as gold investments may come with some risks and uncertainties. Gold prices can be affected by a wide range of factors, including interest rates, inflation, political instability, and supply and demand, leading to the volatility in price. Also, the gold market is considered to be a speculative market, where emotions and perception can play a bigger role than the fundamentals, leading to overvaluation or undervaluation of the asset. The desire and excitement for gold, also known as gold fever, has been a characteristic of human nature throughout history. It's driven by the perceived value of gold as a safe haven asset and store of value, as well as the limited supply of new gold. Interest in gold has been high in the United States, especially in recent years due to economic uncertainty and market volatility. While gold can be a good investment, it is important to be aware of the risks and uncertainties associated with it and not to get carried away by emotion or hype. The California Gold Rush. The California Gold Rush of 1849 is a well-known event in American history, but there are certainly some lesser-known stories and facts about the rush that may surprise you. Here are a few examples. One of the most interesting and unusual stories from the gold rush involves a man named Johann Augustus Sutter. Sutter was a Swiss immigrant who settled in California in the 1840s and established a successful farming and trading empire. In 1848, one of Sutter's workers discovered gold on his property, and the ensuing rush of prospectors effectively ruined Sutter's business and left him bankrupt. Despite being one of the first people to benefit from the discovery of gold, Sutter's name is not often remembered in association with the rush. Another little-known fact about the gold rush is that Americans weren't the only ones who went to California in search of gold. People from all over the world, including China, Mexico, Chile and even Australia, are flocking to California to try their luck. This led to the creation of racial communities, such as the large Chinese colony in San Francisco that still exists today. Many people who came to California during the gold rush were single and away from their families. This led to a shortage of women, leading to a unique phenomenon known as California marriage. Following the practice, women traveled to California intending to marry one of the prospectors, but often went unnoticed. Some of these women were treated well by their new husbands, but others found themselves in difficult or abusive situations. The gold rush also had a major impact on the native peoples of California, as the influx of miners and settlers displaced many tribes of Indians who were killed by miners and driven off their lands. The discovery of gold in California and the impact on the world gold price at this time. The discovery of gold in California in 1848 had a significant impact on the world gold price. At the time, the world's economies were based on the gold standard, which meant that the value of currency was directly tied to the amount of gold that a country held. The sudden influx of gold from California caused a dramatic increase in the amount of gold available on the global market, and this led to a corresponding decrease in the price of gold. This decrease in the price of gold had several consequences. First, it made gold less valuable as a store of wealth, which led to a decrease in demand for gold and a corresponding decrease in the price of goods and services. This had the effect of increasing the purchasing power of people who held gold or gold-backed currency. Second, the decrease in the price of gold had a negative impact on countries that were on the gold standard. These countries had pegged the value of their currency to the price of gold, so a decrease in the price of gold led to a decrease in the value of their currency. This led to a monetary crisis in many countries, particularly those that were heavily dependent on gold exports. Finally, the California gold rush also led to an increase in the overall money supply, which led to inflation. This is because the gold rush increased the amount of money that people had access to, which resulted in a significant increase in economic activity and prices. The gold price fluctuation had a profound effect not just in the United States but also throughout the world, as it affected the gold standard and the global economy. It also affected the US expansion with the gold discoveries, leading to the annexation of California, Nevada, Utah and parts of other Western territories. In summary, the discovery of gold in California had far-reaching effects on the world economy, affecting the value of gold, currencies, prices and expanding the influence of the United States in America West. Thank you for watching the video. Please like and subscribe.